Hey everyone, welcome to CoveredCall ETF Investing, your central hub for deep CoveredCall ETF data. And in today's video, thought it'd be a good idea to just pop open the hood once again of the portfolio, do a full unveil. We'll be talking about price performance of the portfolio, total return. We'll be looking at all kinds of different metrics in Wealthsimple, comparing it against other indexes. We'll be looking at weightings through Passiv. So a couple of tools, especially if you're not familiar with them, that hopefully will be insightful for you, and also to show you all what the destination with my investments are, as I believe that's pretty important to have that end goal in mind, and basically that has to do with exiting out of home ownership, and basically I'll just talk about where the CoveredCalls ETFs and their distributions, how that will play into that. So without chatting about it any further, let's actually open up the portfolio and get right into it. So the very first thing we're going to look at is just show how my investments have grown since the beginning of the year. Here in Wealthsimple, the free version, well, you used to be able to see a much bigger, a longer time frame. You could go back basically, if you started with Wealthsimple, say in the beginning of 2023, like I did, you could see how your investments have grown on this chart line over the entire time. But that's been taken away, so we'll have to settle with the next best thing here on the free version, which is just seeing it from the beginning of the year. But I started the year 157,000. That has grown to a top of 159, but over the past week, of course, there's been a market pullback, long overdue in my opinion. Is that something I'm worried about? No, because I'm invested for the long term. This is not something that I'm going to just withdraw all my investments because of a small pullback. There's certainly been bigger pullbacks, especially in 2022 with the bear market. If you've lived through that, a pullback like this shouldn't hopefully affect the psyche too much. So with that, we'll head over to holdings. I don't know anything about this wealth scope, but it used to be at like 55, 60%. Now it's up to 80%. So always good to see improvement somewhere, but again, that doesn't really mean much to me. It's not something I focus on too much. So asset allocation, we can see that I'm pretty much 100% in equities, like basically no cash, no fixed income, no tangibles, no crypto. As far as Canadian funds that I invest in, but these can be funds, the Canadian funds that invest in American stuff, but you can see there's about almost 59% there, and then American stuff that I invest in is around 41%. I should say this, I invest with 100% in Canadian fund managers who then invest in various other either Canadian companies or American companies. So it's just a different way of looking at that. Then, of course, the portfolio performance of every individual fund will go straight to what actually matters here. So I'll move the webcam screen over there. The top performer right now is ENCL. Great to see, especially for energy. ENCL is going to bounce around over time. It'll go down to probably, it'll be negative, but it'll bounce up again to 10%, maybe, who knows, even higher. That's just kind of the nature of energy. But anyways, at the moment, it's the top performer. But for the longest while, it was actually HTAE. As a matter of fact, the price performance hit a max of like 22% at one time a couple weeks ago, maybe about 7-8 days before I recorded this video. It was probably hovering somewhere in the 18 to 19% range. So definitely created a bit of a buffer, a good size buffer for this pullback, and now it's down to roughly 6.11%, and I've actually been buying into it much more. If you follow me on Blossom, you will see those trade alerts, and I've been buying up HTAE fairly regularly, and there is a reason for that, but I'll chat about that more once we hit the passive tab. BMAX, I really like BMAX. BMAX is it is an all-in-one. It's an ETF that invests in other ETFs. It's the best performer of those ETFs. Just on a price performance level, total return, I think these other guys would probably beat it out, but it is just such a steady buoy in the portfolio to have. And that's exactly why I have BMAX in there. Not the biggest yielders, probably one of the lower yielders at 10%. I focus on 10%, so when I talk about smallest, 10% is still a great yield to have. But nonetheless, compared to everything else, it's one of the lower ones. But it's so steady, and its underlying pays out very regularly, long distribution streaks for the vast majority of those funds. HYLD is that American fund, again, a Canadian fund manager that I invest in my spousal, my wife's spousal RRSP. And HYLD.U is doing just fine over there. So I make a little bit. I've definitely done all right on the total return performance, but also on the currency exchange as well since I've had HYLD.U. But either way, 4.2%. And then just to kind of round out the middle section here, we got ETFs that invest in other ETFs. They're doing, they're hanging in there. But that's the goal that I've wanted. I like to say I'm yield seeking, growth leaning. Okay, simply meaning that I like to invest in funds that have a decent yield, usually between 10, 12, sometimes higher percent, but have the ability to grow their share price over time. For me, that's just an extra psychological win, along with getting distributions every single month. At least you're still getting that payout. So these ones are performing in line with how I'm hoping that they will perform. And then the ones that are kind of lagging behind a bit are the sector funds in financials with BKCL and HMAX, and UMAX kind of rounding out the bottom at negative almost 6%. But with the total return, if that function we could see is the total return would definitely boost all this up into at least close to probably positive territory. I would imagine all of this would be positive if I factored in total return here with every individual item. And then of course the NCL being the other sector fund I have doing the best. HTAE, the other sector fund doing the best, pure technology fund. Let's move along. Let's look at income. How much income have I generated over let's call it the past 12 months. So in order to do that, we gotta go here. We'll just do the past 12 months. So what does that look like? Okay, so yeah, you can see that there's this, it topped out here, and then like all the distributions kind of declined. That was because I sold off a bunch of stuff. I was kind of waiting at the mid last year, right? We were all kind of waiting for this big recession to hit. Never happened. So bought back in, and ever since then, I'm going to be steady all the way. And ever since September, I was receiving a total of $1,446 per month, and that has steadily increased all the way up to, as of this month here in April, to $1,836. So with that being said, let's move over into performance. So we'll be checking out what this portfolio has done this year to date. Okay, so let's see what the portfolio has done year to date. Now, if I click on these to compare it to other indexes, it just doesn't work. This function, for whatever reason, I didn't get it as a paid member. I don't get it as a free member. It just doesn't seem to work either way. But as a total return to start the year, you can see the increase over time. Topped out at about 13% total return over the past week. It is down to 7.74%. So quite the drop. But nonetheless, let's check out how the portfolio is doing versus other indexes. So keep that number in mind, 7.74%. Here are the other indexes, the other major indexes, if you're curious. So we got SPX, which is the S&P 500. NDX is the NASDAQ 100. We got the TSX, which is basically the Canadian stock market, and the Dow Jones Industrial. And as of right now, the CoveredCall ETF portfolio, which I haven't really talked about this year, is, now it's not like the year is early. Like, we are now entering into more of the midpoint of 2024, and the CoveredCall portfolio on a total return basis is beating these indexes by leaps and bounds. Quite surprised by that. These funds are not meant to be doing. They're not meant to do that. They're not built that way. But nonetheless, here we are. Total return is doing just that. So beating out the top index, which is the TSX at the moment. The Canadian funds are doing just a little bit better than that, holding up a little bit better than the American indexes at the moment. So yeah, 7.74% for total return. So, booyah. All right, let's move over to Passiv, which is another great free tool. Yes, there's a paid version for it that you can get, but this is a tool that can help you set targets, and I'll show you what I mean if we click on the TFSA. So you'll see here, as I go through and I scroll through, I have a target over here. This is what I'm shooting for. So if it's higher, I'm no longer buying it. I'm just kind of letting, as I invest in other portions of the portfolio, this actual number grows smaller and smaller. Okay, so this is the target I want for BMAX. BKCL, you can see I have no target. You can see it's 0%. Well, its actual number is 3.6%, but the target is 0. That is because for all the Canadian stuff in my portfolio, the BKCL, HMAX, ENCL, and UMAX, I am either basically going to sell them off eventually, slowly over time, up until next year. There is a reason for that. These are not bad funds. I will be getting back into them once I enter into a taxable account, which is getting a lot closer. I'm probably, I would say, maybe about $16,000 away of contributions before I max out my TFSA. So just waiting for that so that I can have another, basically a taxable account with just Canadian stuff in it. So not bad funds at all. Call, I sold that off and basically took that money and put that into HTAE. You can see that the target again for ENCL is 0. My actual is 9.3. All the all-in-ones, so HDIF, HDIV, HYLD inside the portfolio in my TFSA has a target of 17%. So obviously I got a ways to go with all of them, 12%, 12.5%. HYLD and I think USCL, they're all 17%. That's the allocation I've put. And HTAE, I'm actually going to keep inside the TFSA. I put a massive target at 25%. So that's why I've been buying it up. Is as HTAE has shown weakness, I'm just continually buying out of it. So call, I was a little bit up in, and I knew I didn't want to keep it anymore. So I just positioned that money into HTAE. With further weakness, I'll continue to buy that up. So this might be a decent opportunity to sell off bits of ENCL and put that into HTAE. Again, just want to try to buy into the weakness of the tech sector at the moment. It's still fairly pricey, but I think it still has a little bit of a ways to go. And that will get me much closer to my 25% target. So why 25% versus, say, the 17%? Well, again, HTAE is meant to be that propulsion for the TFSA, which is going to be very growth oriented for what I talked about. Yield seeking, growth leaning. Whereas my eventual taxable account will be purely income driven, especially invested in just Canadian stuff. With financials, energy, and utilities, those sectors just, again, cyclical. They'll move up, they'll move down, but for the most part, they're just steady Eddie sectors. So yeah, everything pretty much, if it doesn't have a 25% weighting, the all-in-ones have a 17%, and then BMAX has a much smaller one. I may up that a bit. I'm not sure, but again, it'll be trimming around the edges, and this could certainly change over time with what I'm trying to do in this portfolio. And then we go over to the spousal RRSP. That's gonna just stay the same. A very boring, just one fund in there. But I'm pretty happy with HYLD overall, especially when Hamilton got rid of their they kicked out all those third-party funds. They jacked up their distributions, which is why you see those bumps. Well, you see that bump in my income in March. One of them was just due to the single effect of that jumping up so much was just the combination of HYLD.U, HYLD, and then HDIV, those distributions bumping up. So before we move on here, what does all this mean? All these different weightings, performances. What is my goal with a portfolio, especially set up with the targets that I have? So I'll share that before we get into the next section. And basically put, as most of you know, and basically the vast majority of this audience are Canadian. Home prices, as we know, nothing new, is just crazy. If you don't own a home, I do feel for you. Trust me, I do. I'm sure the sympathy is probably not as reciprocated because I do own my home. But the reality is, for most of us, especially if you have families like I do, I got 3 kids, married, the idea of moving up into something else is pretty hard to stomach. And I'm a single income, and there's just no way for me to even if I take the equity in my home, put it towards something else. I feel like I'm just on a hamster wheel, and that hamster wheel of just gotta work harder to afford the mortgage, to try to move up, and I'm not interested in chasing the Joneses, is basically what I'm trying to say. I have been developing, I would think, an alternate version of ownership that doesn't involve owning a home. And that's something I just simply call just asset ownership. It's basically own the economy so that the economy can take care of me, especially with these high yield funds. And that is the direction I'm going in. So next year, I plan on selling my home with my wife, and we plan on going into a rental house, preferably, but bare minimum, basically a townhouse at bare minimum, and a house potentially. Something that's bigger. Right now we live in a 2-bedroom condo. We did renovate it to make it a 3rd bedroom. So basically our deck is now a bedroom for my 2 oldest boys. So they share a room, and the youngest one has his own room. So it works right now, but hey, they're fast growing, and we, of course, with 3 kids, especially 3 boys, we need more space. So next year, probably around this time next year, we'll probably put our place up on the market, and we will search for that rental. So where exactly do these funds come in between spousal and TFSA? Well, I'm going to be taking the equity in my home, putting that into a taxable account. I figure on the low end, it'll probably be around $150,000 I'll be putting into a taxable account. And those will basically invest in 3 sector funds, maybe one all-in-one fund, which will be ENCL, UMAX, and probably bank. The higher yields, that's what I'm going for. And those higher yields will help produce or generate the money needed to get into these rentals that I'm about to show you all, that are a little bit, of course, on the pricier, not for what we're not used to, I guess. I think for most of us, what we're not used to, certainly what I'm not used to, but that equity can help alleviate what I'm actually going to have to pay. So let's actually just look at that and see what I'm up against here. What would I actually consider buying. So this is, I live in Vancouver. I live in a suburb of Vancouver, South Surrey, pretty close to the border with the States. So on the low end, this is what I'm looking at for a 3-bedroom. I'm not going to get that because that's a condo. I'm not getting this because that's crazy and expensive. This rental has been sitting for a long time, but it's not going to. I don't see that moving. They got to lower that. Something like this, I'd probably get into something like that. 3,500. That's within my range. We get a house, full house. At $3,850. Just wait until we start calculating a mortgage, because that's what I'm going to do in this video, just to show you a comparison of what. Now this again pretty much on the high side. My goal is probably something under 4,000. I'd consider maybe 42 max, 4,300. I know for a lot of people this looks, those kinds of rental numbers look really high, but I think the reality is you hear about a rental crunch here in Canada, but that starts to alleviate once you start getting out of that competitive range of like 1,400, 1,500, 1,600, where there's lineups of people waiting to see a basement suite, right? But when you're talking about an actual townhouse, an actual house, a lot of these townhouses and houses, I look at this often. Very regularly. Most of these homes in my target neighborhood, I've been in many of them because I like to scope out open houses, and I used to do a lot of real estate flips with my family. So that interest in real estate and just a general curiosity for what you can get for this, I'm pretty familiar with. But I mean, for turnkey, moving right in, these aren't junky by any means. It would certainly be a desirable improvement to what I currently already have. And as we obviously kind of move down the list here, we start getting into like a rancher. Some of these aren't, brand new, but that's okay. I just need a roof over my head and a little bit more space. So that is pretty much the goal for us, is just to get into one of these. And I mean, here's a house like this is at 4,200. This is something I'd consider paying a little bit more for. Even this right here, 4,300 for this. It's got a yard. It's got like big. So all of a sudden your dollars start to move a little bit more the higher you go up. It just looks as if you can take those dollars, especially if you invest them in CoveredCall ETFs. I would certainly say, especially for younger people, there was a time I would have said, CoveredCall ETFs, certainly way more for the older crowd who want to supplement their income, especially as they exit out of the workforce. But for younger people, this could potentially be something that potentially, hey, if you're not happy with the house prices, maybe investing in CoveredCall ETFs and maybe getting in and just moving up the real estate ladder. Maybe that's the way to do it. I don't know, but that's what I'm going to do. And I'm going to continue to document that and let you all know how that goes. So, as far as rentals are concerned, you can get some pretty nice stuff for even 4,500. But yeah, that's even for me, that's kind of on the pricier. That's on the pricier side of things. So hopefully you don't look at that like, wow, that's expensive, I'll never afford that. But keep in mind, with CoveredCall ETFs, you can do a lot more with less of it. So your investment portfolio doesn't need to be as big to offset the cost of some of these places. And just so you know, once I move my basically equity in my current home, move it into the taxable account, it doesn't pay for everything. Basically, my costs will stay the same. They will. I've done the math. They'll stay the same. But between what I pay on my mortgage, my strata, my property tax, my utility. I was going to say like sewage, just general maintenance. It's already quite it's already quite high. So paying something like this isn't that much higher, especially if it's offsetted by those covered call ETFs that I was talking about. And then with the spousal RRSP, this is probably also another good one to think about. Is I got into the spousal RRSP as a flexibility move with RRSPs. Yeah, I got into it mainly because that in time I get the tax write-off, but if I stop contributing to it for basically 3 years, I can then withdraw from it, and it'll be at my wife's lower tax rate. So the account is in her name. I get the tax write-off because I'm the contributor, and she's what's called the annuitant. So as of now, I've contributed in 2022. I've contributed in 2023. Going forward, I'm no longer going to be contributing. So in August of 2023, that's when I contributed lump sum. It was basically about $8,000. That's the max I could do. I get a pension through my work, so it offsets the max RSP deduction limit, basically. So come August of 2026, I'll be able to start withdrawing that. It'll go under my wife's much lower tax. Well, she bless her soul, she takes care of the kids, takes them to school and whatnot, and does that amazing motherly work. But this would technically be her income. She'll get taxed at that income. So I'll probably take it out in two withdrawals. One in August of 2026. That'll go to the taxable account, and then early in 2027, just to offset it a little bit. So if I take it all at once, it's a much bigger hit. But I'll just do it in 2 different tax years, and just buffer that tax impact. But I think that should go hopefully okay with that. The taxable account is also going to be set up in my wife's name as well, just as we get paid, as she has the much lower tax situation than I do. I'm in a high tax bracket. So anyway, that's what we're going to do with that. So my plan is basically pretty clear cut through 2027. At 2027, once the spousal is fully moved over to the taxable account, basically for any of these homes, I'm honestly paying like $1,000 out of pocket. So the covered call ETFs are going to do wonders, especially if that's what you decide to work towards. If I was to buy a home, this is the cheapest thing in my target neighborhood. This 1972, it's pretty big for being at 1,900 square feet, 3 bedroom, 2 bath. But let's actually do a calculation and see what. So if I sell my home, let's go 150, and again, that's on the low end. Let's go, 30 years. So I'll be paying $3,307 a month with current interest rates. But let's also not forget, what's the strata on this place? Somewhere in here. Okay, let's just call it 400. Let's call it 400. So that puts me up to 3,700. And then we got property tax. Let's just call that, what? That's $200 a month, something like that. That's a $200 and change. So you're already looking at $4,000 a month in just mortgage payments. And that's with 20% down. Sure, I could funnel a lot more of my investments out and put it towards this, have a much lower payment, but that's just the cheapest thing in my target neighborhood. Okay, if we just head back, like they easily bounce up into the 800s. So now we're talking exponentially more. And I'm telling you, I want to be able to travel with my kids. The idea of just being married to a mortgage does not appeal to me whatsoever. I don't want to do it. I want to be as free away from that kind of stuff as humanly possible. One of my even just something I've realized recently is, especially when you read entrepreneurial books, you listen to entrepreneurial people, and it's the whole idea I consistently talk about. Surround yourself with the language of finance, but that language also applies to whatever it is you're trying to learn. And in this case, that would be, set yourself free from your day job so you can do whatever you want. But if I'm really honest, I actually really like my day job. I build ships for a living. I'm a pipe fitter, and I really like where I work. So I really have no intention of leaving. That isn't to say I don't necessarily. I think I'll certainly put myself into a financial position to rely on that income less and less, and I think that's just smart finance. And especially financial maturity, the more you go along, the idea with investing is trying to buy back your time. And I'll certainly be doing that throughout these next couple of years. But I'm pretty happy where I work. I don't have the strongest desire to take this full time, to do 3 videos a week. I would love to talk about this more, but at the moment I'm pretty happy doing 1 video a week, and and also chatting with you all once in a while. Certainly done plenty of video, or what do you call that, Zoom calls with all of you. But anyway, yeah, so I don't know. Tell me if I'm crazy. Let me know if you all agree. Is this a certain an admirable goal to have? What do you all think? Is renting potentially the better way to go here in Canada, especially with a CoveredCall ETF bent to it? So please let me know. I appreciate all the comments. Thank you for everybody who continually participates in the comments. I appreciate that. Shout outs to the likes of Dividend Shark and Tom and John and Derek and Antoinita. I'm sorry, I'm a terrible Antoinita. And Sean Tours, of course. I'm just doing this off the top of my head. And last but not least, if you want to just check in on the performance of my portfolio, you can certainly do that in the community tab here. Basically, you can just see week after week, I just post what my portfolio is doing on a price performance level, on a total return level versus total return of other indexes. So this is just a quick snapshot every week if you don't necessarily want to watch a video. And as always, of course, you can pick up my my CoveredCall ETF spreadsheet, which is just a great and fantastic tool. Yes, it's self-serving. Yes, I'm biased to it or created it, but it's a great tool to enhance your education around CoveredCall ETFs. It will speed it up. Such great stuff in here, and I've gotten a lot of good feedback about it. So pick that up on my Patreon. It'll be in the description below, or you can pick it up for $13. It is subscription based, so you could get into it once, cancel if you just want it the one time, but I'm continually updating it, more funds, more ways to learn, and yeah, more opportunities in the Patreon to connect. I got some ideas in mind. So with that being said, hope you all have a good day, and I'll see you all in the next video.